Hey everyone, every year many young people start their financial journey in India with dreams like buying a car, buying a house, vacation goals, and as you get married and have a family, you have more financial goals like your children's education, their marriage, and the ultimate goal of every person, that is retirement. Everyone wants to live a financially comfortable life and have a secure future for themselves and their family. Now some people say that money is not everything, but the fact is almost everything needs money. So you need to ensure that you earn enough before you say money is not everything. And that requires proper financial planning to help you achieve your financial goals. And that's where in today's video, we'll discuss the various steps involved in financial planning. I've identified 5 steps that can help you in your financial journey. I'm sure this video would be very helpful for people across age groups, especially when you have recently started your financial journey. Alright, let's get started. So the first step in financial planning begins with gathering your financial data. Here you need to first list down your sources of income like salary, interest payment on FD and any rental income and so on. Then list down the expenses like home rent, EMI, groceries, medical expense, eating out and so on. In case you have yearly payments like life and health insurance, premium, travel expense, etc., you can divide it by 12 and add it to monthly expense. Friends, I've seen cases when in spite of earning a good income of 1 to 2 lakh a month, many people are struggling to invest because they have no idea where their money is going. Hence, you should have a fair idea of inflow and outflow of money on a monthly basis. So if you are spending too much on a particular segment, you can control it. Next, you need to list down all your assets like home, land, FD, mutual funds, etc. and liabilities like your car loan, home loan, etc. This would give you a clear picture of your current financial status. Now once you get this idea, you can proceed to the second step. In the second step, you need to list down all your financial goals. Here it's very important to have a SMART goal. SMART means specific, measurable, attainable, realistic and time bound. Specific means you need to know exactly what you want and when. For example, if you say, I need money to pay my college fee in a year's time, then it is an incorrect approach. The right approach is, I'll save rupees 50,000 to pay my fee at college. Measurable means your goal should be measurable so that you know when you can achieve it. Here incorrect approach is, I'll pay off my debts to my friend. Right approach is, in the next 6 months, I'll return rupees 32,000 to my 2 friends for lending me their money. Attainable means your goal should be reasonable, that is within your reach. So don't say I'll save money. Say I'll save rupees 2,000 each month by cutting down on eating out and partying. And realistic means your goals needs to be based on resources and tasks that you can reasonably accomplish. So don't say I want rupees 100 crore in next 5 years. You need to understand how much money you can realistically save to achieve a certain target. For example, today I earn rupees 50,000 a month, my expenses are 30,000 a month. If I save and invest 20,000 a month via SIP in equity mutual fund, assuming 13% interest rate, in next 10 years, I can achieve a corpus of 47 lakh rupee. And last, time bound means goals with timelines allow you to track your progress. Here right approach is, I'll save rupees 10,000 every month for the next 2 years for my vehicle. Once you list down your financial goals and the tentative corpus required for your goals as per your financial state, you need to break it into 3 buckets. Short-term goal, mid-term and long-term goal. For example, a goal within 3 years would fall into short-term. 3 to 5 years would be a mid-term goal and anything above 5 years is a long-term goal. Now let us look at the next steps. So once you prepare the list of your financial goals, you should take care of 3 very important aspects of financial planning that falls under risk management. Here, first you need to build an emergency fund that should have 6 to 9 months of your monthly expense and keep this money in safer investment options like FD. It's because life is uncertain and you might need money in case of an emergency. In such cases, if you have emergency fund, you won't have to borrow money for anyone. Second, ensure that you take a term plan, because in case anything happens to you, your family should live a financially comfortable life. And third, take health insurance because healthcare cost in India is rising at a very fast rate. Just a few days of hospitalization can wipe out all your savings and investment. Hence, a right health plan would ensure that you can get the best medical treatment without worrying about the medical expenses. By the way, there's a very good health insurance product by Care Health Insurance. It's called Care Supreme. So Care Health Insurance is a specialized health insurer with a network of over 21,600 cashless healthcare providers and has covered more than 9 crore lives since inception. Their comprehensive health insurance product Care Supreme offers some amazing features like 7 times increase in your base sum insured with cumulative bonus and cumulative bonus super. Here your base sum insured would increase to 7 times even if you claim or do not claim. For instance, if your base sum insured is, let's say, 10 lakh rupee, then in 5 consecutive years, it will increase to 70 lakh rupee. Second feature is unlimited automatic recharge of sum insured. Let's say your health cover is 10 lakh rupee and the entire amount gets exhausted in a single claim. Then your sum insured amount will get replenished in the same year. This sum insured amount will automatically get recharged as many times as required within the same policy year. So if you have any medical emergency again within the same policy year, you can be rest assured that Care Supreme will provide you the required health cover. Third interesting feature is there is no cap or sublimit on conventional and advanced treatment, hospitalization, Ayush treatment, domiciliary treatment and organ donor cover. Fourth feature is there is a wellness benefit for maintaining your fitness level. So there is a discount on renewable premium up to 30% if you fulfill the mentioned criteria of healthy days. Fifth feature is optional benefit like instant cover that helps in reducing of waiting period even for pre-existing disease to 30 days. For more details, you can explore the link that I have provided in the description and pinned comment, and you can also avail 5% digital discount. Once you know your current financial status and financial goals and take care of risk management, fourth step is to prepare a financial plan as per your financial goals and risk appetite. Here please note that every person has different financial goals and risk appetite. For example, a person with a portfolio of rupees 10 crore would have a very different risk appetite as compared to a person with a portfolio of 10 lakh rupee. So for example, if a person with 10 crore rupees portfolio lose 20-30% wealth, it won't make much difference in his life. But can a person with 10 lakh rupee portfolio afford to lose 20-30%? I doubt. A lot of people blindly follow ace investors in India. The moment there's a news that they purchase stock of a company, there's a rush to buy the stock. But what they fail to understand is even if Ashish Kacholia or Vijay Kedia invest rupees 10 crore in a microcap company, it's not even 0.5% of their portfolio. And even if they lose money in a company, it won't make any difference to their portfolio. So always assess your risk appetite before investing your money. Even worse, there have been cases where people end up investing money in very risky asset or end up doing F&O trading or crypto trading without any knowledge. As a result, rather than creating wealth, they end up losing their money. Hence, it's important that before you start investing your money, you understand your risk appetite. Always remember that it's not just about returns, it's about risk-adjusted returns. Moreover, your investment decision should also consider your financial goals. For example, you may want to purchase a house in 3-year time. Let's say retire after 20 years. But your child's education in a great school, you may require school fee every year. A goal-based approach helps you understand the timeline of each important milestone. For example, if after all your expenses, you are able to save rupees 75,000 per month for investment, then without a goal-based approach, you will simply pick a few stocks or mutual funds and spread the money randomly. But with a goal-based approach, you know that your most immediate goal is school fee of 1.5 lakh rupee that is required every year. And for that, you should keep your money in safer options like FD or low volatility options like triple rated or double rated bonds or debt mutual funds. Then next comes your 20 lakh down payment for home purchase in 3 years, which again is not a long-term goal to deploy money entirely in equity. Yes, if your goal of home purchase is in the next 5 to 7 years, then you can certainly deploy money in equity market like stocks or mutual funds. Finally, you have an early retirement corpus of 5 crore but in 20 years. For that, you can certainly invest in equity market. When you understand this clearly, you can now prioritize and distribute the money of 75,000 across asset class in the right proportion for each goal. And that takes us to the final step of financial planning. Once you understand your risk appetite and financial goals and manage your risk, the final step is implementation of your financial plan. And there are various asset class available in market to invest money. So you need to carefully assess your requirement and create an asset allocation plan. Here, before you directly jump to asset allocation, you need to understand two very important concepts. First is power of compounding. Compounding is a tool that can help you create phenomenal wealth in the long term. Here the key is long term, because during the initial few years, compounding won't make much difference, but eventually it will. This slide shows the difference in return of FD at 7% and equity mutual fund at 13%. For the initial 3 years, equity mutual fund would be only 17.7% higher, but after 5 years, it would increase to 31%. 10 years later, equity mutual fund return would be 72% higher. 15 years later, it would be more than double. 20 years later, FD at 7% would fetch 38 lakh rupee on initial investment of 10 lakh, whereas equity mutual fund at 13% would fetch 1.15 crore rupees. Can you see the difference? For the initial few years, you won't see a major difference, but after a certain period, you will realize the difference between 7% return and 13% return due to power of compounding. Yes, your returns from equity mutual funds won't be linear. It would be volatile. So you need to assess your risk appetite and goal duration and decide how much allocation you want in FD and how much in equity mutual fund. Second concept is time value of money. In simple language, the value of money reduces with time. For instance, if you have rupees 100 today, next year its real value would be less than 100. Simply because of inflation that includes an increase in price of everything like food, fuel, rent, school fee and so on. In general, the inflation rate in India is around 6%. It means 1 lakh, if kept in cash, would actually be worth 55,800 rupee in next 10 years. Hence, you need to ensure that your investment should be able to beat the inflation by a decent margin. Now, broadly, if you look at various asset classes in India, you have got fixed income instruments like FD, PPF, post office scheme, then you've got gold, then you've got real estate, then you've got equity market that can be further divided into individual stocks and equity mutual fund. Based on your risk appetite and financial goals, you can allocate your money across these asset classes. Here remember that each asset class has a different risk and return profile. For instance, fixed income instruments are a lower risk, lower return category. It's suitable to park money in case of emergency or short-term goals. Then gold is a good hedge against currency depreciation and can expect 8 to 10% return in the long run. So you can allocate, let's say, 5 to 10% capital in gold. Then real estate returns vary from location to location and it also requires a lot of capital. Finally, the equity market offers one of the best return of 13 to 14% CAGR over the long term, but it comes with high volatility. It means there can be a few years where you can get very high returns and a few years with very low return. Hence, the equity market is suitable for long-term financial goals with an investment horizon of more than 5 years. Here you can consider both stocks and equity mutual funds based on your knowledge and expertise. If you don't have much knowledge and expertise and do not get enough time for research, better you have higher allocation in equity mutual funds. As far as investment strategy is concerned, the best way to invest is via systematic manner. Every month when you get earning, set aside some money to be deployed in each of these asset class as per your financial goal. This strategy is known as SIP, that is systematic investment planning. So in this video, we discussed various steps involved in financial planning in India. If I quickly summarize, it includes gather your financial data, list down all your financial goals, then risk management, that include building an emergency fund, buying a term plan and health plan. Fourth step is prepare a financial plan as per your financial goal and risk appetite. And fifth step is implementation of your financial plan. I hope this step-by-step framework would help you in your financial journey. And if you find it useful, do share it within your circle. Also, if you are looking for a good health plan, do explore Care Supreme. It really offers great feature. Link I provided in the pinned comment. So this is it for this video. I'll see you next video. Till then, take care.